Silver doesn't need a headline to change the temperature of the room. A move of around 6% to $85.46 is enough. Enough to make people sit up straighter. Enough to make timelines light up. Enough to turn a quiet market into a loud one. And a loud one into something that starts behaving like it has a personality. And silver always does this thing when it gets loud. It invites you to make a decision quickly. That's why the real question isn't just bounce or wave. The real question is whether this move is building stability or building fragility. Because stability creates bounces that turn into bases. Fragility creates waves that turn into traps. So today we're going to break this down without the fortune cookie price targets and without the one-line narratives that collapse the moment the next candle prints. We're going to talk about what a 6% spike in silver actually signals, how a bounce behaves differently from a volatility wave, why silver is uniquely good at turning attention into self-feeding motion, and the exact behaviors I'm watching next, so you can stop getting emotionally whiplashed by the same old pattern. Quick check-in before we start. Comment one word, bounce or wave. Not what you want. What you think the tape is trying to do right now. Bounce or wave. Then we move. Okay, first let's clear out the biggest mistake people make with silver. They treat silver like it's a normal market that politely expresses information. It's not. Silver is a market where structure and positioning can matter more than the story in the short run. And that's why the lazy version of analysis, silver spiked because X headline, usually fails. Silver often moves because the path of positioning changed, because liquidity shifted, because risk controls tightened, because someone got forced, or because a cluster of orders around a key zone got triggered. In other words, the how often matters more than the why. So instead of asking why did it spike, the better first question is, was the spike healthy or fragile? Healthy means the move improves the market's ability to hold gains. Fragile means the move increases the odds of violent reversals. And silver is famous for violent reversals. Now before we talk bounce versus wave, you need one foundational idea. Silver lives in two worlds at the same time. There's the physical world, bars, coins, fabrication, shipping, inventory, delivery schedules, premiums, and the boring reality of bottlenecks. And there's the paper world, futures, options, ETFs, leveraged exposure, synthetic claims, promises that can expand and contract far faster than physical metal can move. The screen price that headlines quote reacts mostly to paper flows in the short term, especially when volatility rises. That's why you can see spot surge while physical premiums barely budge, or spot dump while physical availability stays tight. Two worlds, one quote, and a lot of confusion for people who assume the chart must reflect the physical reality in real time. Now let's define what we mean by bounce. A bounce is not just price going up. A bounce is a move that creates a higher level of stability than before the move. In a bounce path, you typically see this sequence. A sharp up move grabs attention, then price consolidates without giving everything back. Pullbacks are smaller and get bought without panic. Rebounds hold for full sessions rather than fading within hours. Daily ranges start to compress after the initial excitement. The market starts to build a platform instead of a trampoline. The key word is stabilization. Now define volatility wave. A volatility wave isn't just movement, it's self-feeding movement. It's when the market becomes reflexive, the move creates attention. Attention creates positioning. Positioning creates fragility. Fragility creates forced trades. Forced trades create bigger moves. And those bigger moves create even more attention. That's the loop. In a wave path, you typically see this. Big candles in both directions. Frequent intraday reversals. Up hard, down hard, up again. Air pockets where liquidity disappears and price drops farther than reasonable. Bounces that fail quickly, then sudden reignitions that trap both sides. Daily ranges expanding, not compressing. And often behind the scenes, tighter risk controls, margin increases, leverage restrictions, wider spreads, because the system reacts to volatility by tightening. The key word is fragility. So after a 6% spike, the only honest thing to say is the next part matters more than the last part. The spike is the match. The question is whether it lights a candle or starts a fire. Now what can cause a move like this in the first place? Usually it's not one thing. It's a cluster. One driver can be short covering. If there's a meaningful short interest or a concentrated set of short positions, a sudden push higher can force covering. Covering is buying. Forced buying is fast buying. Another driver is momentum chasing. A big green candle is a billboard. It brings eyes. Eyes bring traders. Traders bring leverage. Leverage brings speed. Speed creates more eyes. That's reflexivity again. Another driver is liquidity thinning. If market makers step back, spreads widen, and the order book gets thinner, price can travel farther on less flow. A move that might have been 2% becomes 6% because the market is less able to absorb pressure. Options dynamics can also play a role. Without getting overly technical, certain options positioning can cause hedging flows that amplify moves around key levels. Not magic, mechanical. And then you have the slow-burning driver, physical demand narratives. If physical premiums remain firm, availability tightens and delivery times stretch, That can support buyer confidence. But remember, physical is slow. Paper is fast. Physical often supports the longer-term bias. Paper often creates the violent path. Now this is the part where retail can matter. Retail does not need to be the biggest buyer to be the biggest accelerant. Retail changes the story's speed. People post screenshots. People post receipts. People talk about this is it. That social proof spreads. And in silver, social proof can pull in paper speculation, ETFs, leveraged products, short-term options. Once paper leverage joins, the market becomes more fragile. Fragility is what turns a bounce into a wave. Now I want you to notice something about that. The trap isn't that silver goes up. The trap is that silver goes up in a way that makes people urgent. Urgency creates fragile positioning. Fragile positioning creates forced selling later. This is why silver is a market that punishes impatience, like it's a sport. Now let's make this practical. How do you tell in real time whether this is turning into a bounce path or a wave path? You watch behaviors that reveal who is in control. Signal 1. Follow through. After the spike, does price hold most of the gain into the close and into the next session, or does it fade quickly? Bounce behavior holds. Wave behavior whips. Signal 2. The nature of pullbacks. In a bounce, pullbacks are smaller and orderly. In a wave, pullbacks are fast and violent, often overshooting. Signal 3. Rebound quality. Do rebounds hold for full sessions, or do they get sold within hours? Fast fades suggest wave conditions. Signal 4. Intraday reversal frequency. If you see repeated big reversals, you are not in calm accumulation. You are in a leverage fight. Signal 5. Volatility trend. Does the daily range start compressing after the spike? Compression suggests stabilization. Expansion suggests the wave is building. Signal 6. Liquidity fingerprints. Air pockets, gaps, sudden drops, unusually wide spreads. Those are wave fingerprints. Signal 7. Collateral tightening. This one is huge. When volatility rises, exchanges and brokers protect themselves. Margins go up. Haircuts widen. Leverage gets restricted. Spreads widen. Those changes force some participants to act. Forced participants are the fuel of volatility waves. So if you see a spike and then you hear about margin changes or platform restrictions, don't ignore it. The system is telling you the market is becoming more fragile. Signal 8. Physical versus paper divergence. If spot is whipping while physical premiums remain firm, or availability stays tight, it suggests underlying demand is resilient even if the paper path is chaotic. That doesn't guarantee upside tomorrow. It tells you the market is split-brained, which is common in silver. Now let's talk about the psychology layer, because silver is a psychological market disguised as a commodity. A 6% spike triggers two emotions. FOMO, I'm late, I need in. Relief, it's bouncing, I'm safe. FOMO creates chasing. Chasing creates fragile entries. Fragile entries create stop clusters. Stop clusters create cascades. That's how a bounce turns into a wave. Silver is not evil. It's just hungry. It harvests fragility, and fragility is usually created by urgency. So here's the rule that survives most silver environments. Don't let your position size turn you into an emotional hostage. If a single session move can ruin your sleep, you're oversized. Reduce it. You'll think clearer, you'll react slower, and you'll stop turning the market into a personal emotional exam. Now everyone wants what happens next, so here's a clean scenario tree. Lane 1. Bounce and base. Silver holds most of the move, consolidates, and daily ranges compress. Pullbacks are bought calmly, and the market builds a platform. In this lane, patient money is in control. Lane 2. Wave continuation. Silver whips violently with big up days and big down days. Rebounds fail quickly, then reignite suddenly. Air pockets appear, and liquidity feels thin. In this lane, leverage is in control. Lane 3. Bull trap into flush. Silver spikes, pulls in late chasers, then dumps sharply as liquidity disappears, and leveraged longs get forced out. This lane is brutal because it punishes optimism quickly, and it often creates the comment section war where everyone claims they knew what would happen. Now how do you tell which lane you're in? You don't guess based on your feelings. You watch what the tape does next. In the next 1 to 2 sessions, does silver hold above the spike zone, or does it drift back quickly? Holding suggests bounce behavior. Drifting back suggests wave behavior, or a trap. Do pullbacks get bought and held, or bought and immediately sold? Held suggests stabilization. Immediate selling suggests fragility. Do daily ranges expand or compress? Compression suggests a base. Expansion suggests a wave. Are there air pockets? Air pockets suggest thin liquidity and higher cascade risk. Do leverage conditions tighten? Tightening increases the chance of forced behavior. Now I want to address two different audiences, because the same move can mean different things depending on who you are. If you are a physical holder, the spike is not a scoreboard you need to refresh every hour. Your world is premiums, availability, delivery times, and long-term allocation. Physical ownership is slower on purpose. If you let the paper chart hijack your emotional state, you will make the worst decisions at the worst times, like paying the highest premium in a frenzy, or rage selling into a paper flush. If you are a paper trader, the spike is a warning label. It doesn't say you'll get rich. It says this market can move fast enough to force you. In wave regimes, survival is the edge. Your edge is not predicting perfectly. Your edge is not being forced to act. And the market doesn't have to beat your thesis. It only has to beat your margin. Now let's talk about one subtle thing that separates bounces from waves: closing behavior. When a market is building a bounce, it often closes strong relative to its daily range. It doesn't have to close at the exact high, but it doesn't routinely give everything back. When a market is building a wave, you often see messy closes, huge wicks, reversals late in the session, and a feeling that the market can't decide who owns it. That indecision is not neutral. It's often a sign of a tug of war between forced participants. Now I'm going to give you one more practical tool that helps in silver. Watch the rhythm. In bounce mode, you often get up day, small pullback, hold, grind, then another up day. In wave mode, you get up day, crash day, snapback, crash again, and then a squeeze that makes everyone think it's over, followed by another flush. The rhythm is chaotic, and it's designed to break the weakest positioning. Now what about the number itself? $85.46. People will treat that level as if the decimal carries meaning. It doesn't. What matters is how many participants anchored around the round zones near it, and whether this move changed the market's behavior. Silver is a market where levels work best when they reflect crowds. Crowds create clusters. Clusters create cascades. Now here's the final thought that ties everything together. A 6% spike is not a conclusion, it's a test. A test of whether the market can transition from attention to stability. If it can, you get a bounce that builds. If it can't, you get a wave that feeds itself. And the wave can cut both ways. It can squeeze higher, and it can flush lower, often close enough together to punish anyone who becomes emotionally committed. So bounce or volatility wave? The honest answer is, watch what happens next. Watch follow-through, pullback behavior, rebound quality, intraday reversal frequency, volatility trend, liquidity fingerprints, leverage tightening, and physical paper divergence. Those signals tell you which lane you're in better than any headline does. Now let me add a layer that's easy to ignore when silver is ripping: the difference between a squeeze story and a liquidity story. In squeeze mode, the market feels like it has a target. Price rises, shorts feel pressure, covering accelerates, and the move can look clean for a few sessions even if it's fast. The danger in squeeze mode is not that it can't continue. The danger is that it can reverse violently once the forced buying is done, because the same speed that takes you up can take you down when momentum shifts. In liquidity mode, the market doesn't feel like it has a target. It feels like it has gaps. It feels like it's stepping over empty space. You'll see sudden drops that don't look like thoughtful selling, and sudden pops that don't look like thoughtful buying. That's when you're trading an order book, not an opinion. Liquidity mode is where a bounce can be a trap even if the bigger trend is up, because liquidity mode punishes anyone who assumes the next tick will behave normally. So how do you tell squeeze mode from liquidity mode? Look at the tape's smoothness. Smooth, persistent pushes with fewer violent reversals often suggest squeeze dynamics. Jagged, whippy action with frequent air pockets suggests liquidity dynamics. Neither guarantees the next move, but it tells you the type of danger you're dealing with. Another layer is the difference between paper demand and physical demand. When volatility spikes, in the paper world, demand can appear huge because leverage allows people to control a lot of exposure with relatively little capital. That demand can vanish quickly if margins rise or if risk appetite flips. In the physical world, demand is slower but stickier. People buying physical usually aren't flipping the same day. They're accumulating. That's why in stress regimes you can see paper price whip while physical premiums hold firm. Paper reacts to collateral and positioning. Physical reacts to availability and replacement cost. This is also why silver is up 6%. Doesn't automatically mean physical is about to be cheap or expensive. Physical pricing is a mix of spot, premiums, dealer risk management, and inventory replacement cost. In fast markets, dealers protect themselves by widening spreads. They'd rather sell a little less than sell out at the wrong time and get caught unable to restock. That behavior can make the physical market feel stubborn compared to the chart, and that stubbornness can keep the retail narrative alive even while the paper tape is chaotic. And yes, retail narrative matters because it changes the timeline. When the public starts paying attention, the market starts moving on emotion. People who were indifferent become curious. Curious becomes urgent. Urgent becomes leveraged. Leveraged becomes fragile. Fragile becomes forced. Forced becomes volatility. That chain is how a normal bounce becomes a volatility wave that lasts longer than anyone expected and hurts more people than the headline suggests. So here's a simple checklist you can use over the next few sessions. You don't need fancy tools. You need consistency. First, does price hold above the midpoint of the spike day's range, or does it spend most of the next session below it? Holding above suggests the move has demand behind it. Living below suggests the move is fading. Second, do pullbacks get bought and then held for at least several hours, or do they get bought and immediately sold back down? Immediate givebacks suggest weak hands and leverage churn. Third, do you see wider spreads and thinner liquidity at your broker or platform? Wider spreads are a quiet warning that the market makers are backing away. Fourth, does volatility calm down after the spike, or does it keep expanding? Calm suggests a base. Expansion suggests a wave. Fifth, do you see physical premiums staying firm, or do they soften noticeably? Firm premiums can indicate that the physical side is not panicking even if paper is noisy. And finally, watch your own behavior. If you feel the urge to do something because the candle was big, that's your signal that the market is trying to recruit you emotionally. The market loves recruiting people emotionally. That's how traps get stocked. If this is truly a bounce, you'll have time. Real bases give you time. They don't demand instant action. If this is a wave, the temptation will be to chase speed. Speed is where most losses are born in silver. The wins look exciting. The losses look like a door slamming. So treat this like a professional would. Observe first, size second, ego last. Your job is not to win the comment section. Your job is not to predict perfectly. Your job is to avoid becoming forced. Because silver's cruel little secret is simple. It doesn't care whether you're right. It cares whether you can stay in the game long enough for being right to matter.